We're breaking down the basics, investing 101 that goes beyond shares and property. With simple insights for beginners and a tune-up for seasoned investors, we're giving you the full insights minus the jargon.
We're back in your life, and today we're breaking down all of your investment options, pros and cons. For beginners, this is great. For those sophisticated investors, it's that check-in to make sure we are on the right track. Michael, there are so many options. You hear from friends, relatives, you definitely got to do this.
Yeah.
Definitely don't listen to what you hear on YouTube or Spotify. That'd be crazy.
Yeah. And again, when you are taking advice on this stuff, I think it's important to think about who are you taking that advice from. Just because something has 1 million views doesn't mean it's right.
I mean, probably the more views, the less likely it is to be right.
Oh, like legitimately. Yeah. And I think the funny thing as well is like, there's a ton of pressure for people out there these days, like with social media and that sort of thing. And I'm like, the idea that you have to achieve this like Ferrari billionaire lifestyle if you just do this one quick trade or buy this course, like it's kind of, I feel sorry for people who get caught in that web, and especially for those who kind of invest their money in it and then end up losing it.
Yeah. And it comes back to what we talked about in a previous episode where people just want to get to the outcome immediately instead of being consistent over time. So what we're going to do is we're going to talk to you about really the 4 main asset classes, different types of cash and savings, bonds, property, and shares. So let's start with cash, Mike. What are the different types of ways we can invest in savings, term deposits?
You could take that cold hard cash and put it under your mattress. You can put it in a savings account, a term deposit account, a cash fund. Heck, I don't know, you could even throw it in a pie fund.
Yeah, for sure. So some of the things to think about here is cash is great for the short term. Cash is king in that scenario.
Why is cash king?
If you have a goal under 3 years and you're investing in shares or property, you do not have a long enough time horizon to be confident of the outcome. So you might have a risk tolerance to deal with the ups and downs, but you don't have what we call risk capacity because your time horizon dictates what you're able to invest into.
But James, I saw a video on YouTube that says if I put my money into the stock market through this day trader, he can double it in 24 hours.
Yeah, but I mean, that sounds like a scam first. But even if you're investing in a really well-diversified share portfolio, you have to have enough time to get to outcomes. What happens is that in the first year, you can do really well or really poorly. But if you have a long enough period of time, it sort of averages out. So if you have under 3 years, I would 100% be leaving your money in cash.
Yep.
Term deposits will give you a slightly higher rate of return. But Mike, what's the problem with a term deposit?
It's locked away. You can't get to it. And for everyone going, I can just break that term deposit. You used to be able to break term deposits really easily, especially if you were using it to buy a house. So let's say your term deposit was with ANZ and you wanted to break the term deposit to use as a deposit for your mortgage with ANZ. ANZ would look at both of those things and go, makes sense, let's do that so they get the mortgage. Not so easy anymore. There's still a wait time to get access to the cash. They'll charge you fees. They'll take the interest off you. Just leave it in the bank.
And if you're trying to buy a property, right, and that money's in term deposit, it creates a huge amount of risk.
Yeah, it's just frustrating because when people have to move quickly, it's added admin that you've got to go through just to get your hands on the cash. And for to be honest, for not much return, it's not even worth it.
No. So the benefits of these types of investments are they're flexible. You have low risk. You know what you're going to get out in terms of at the end. Great for specific time-bound goals. The cons are obviously it's not going to go up in value. The other problem with cash is if you actually have money for the long term, but you're worried about investing in general, cash and term deposits are the only investment that are guaranteed to go backwards over the long term. Why is that, Michael?
Because the rate of return that you will earn on that cash will be less than the rate of inflation in the economy.
And some people get excited when term deposit rates go to 6%, but you are just getting tricked. It's just because inflation is high.
Yeah.
And then you're like, oh, you beauty, but your purchasing power is going backwards.
Yeah, absolutely.
So let's quickly touch on bonds. I don't want to spend a lot of time on bonds. Bonds are the next level of risk after cash. Bonds are essentially a debt instrument. So let's say a government or a company goes, hey, can I borrow some money? I will pay you an interest rate, and at the end, I will give you back your money. That's essentially what a bond is. You will very likely have bonds within your KiwiSaver, or if you are in a managed fund. I would put it as a similar time horizon to cash, like sub 3 years. But it's unlikely you're going to have a bond fund in isolation.
Yeah.
It's probably part of a wider strategy.
100%.
So Mike, let's talk about the fun assets. They're the defensive one. Defensive assets have a very important role to play, but people want to talk about property. They want to talk about shares. And we're going to do that after this break. Well, if you're thinking, cool, how do I actually build a portfolio that is right for me? Lighthouse Wealth, day in, day out, takes a client's financial situation and their goals for the future and build the right portfolio for you. We are completely independent financial advisors. We use independent research. Any discounts we receive on funds, we provide back to the client, and we hold zero conflicts of interest when it comes to our portfolio. If you want to have a chat about what the right investment strategy is for you and your goals, click the show notes below. Now, back to the episode.
James, so we've talked about the boring stuff. Let's give them the juicy stuff. What are some of the more aggressive asset classes?
Let's talk about shares. And I think a lot of people make mistakes when they start to invest into shares, right? They end up doing all these stupid things. No hate on sharesies, but they just pick these random portfolios, right?
But you know what? I can't blame people for that. Investing in shares seems like a really safe, good, well thought out thing to do, right? It's not gambling. You're investing for the long term or whatever you tell yourself, right? Unfortunately though, people don't understand the risk of shares. They think fundamentally the risk of shares is somewhere kind of down near bonds. That is not true at all. Shares are fundamentally more risky and a completely different asset class.
Yeah, so some of the main tips I would give you, do not buy direct shares. Michael, why do we tell people not to buy direct shares?
It's fancy gambling. If you're telling me that you invested into Fisher & Paykel because it's a great New Zealand company, it's been around forever, they do a little bit of healthcare and I believe in them, the market does not care about any of that. You have no idea about what the company is doing, the price to earnings ratios, the fundamentals on the book, the board, the leadership team, the strategy. That is what the market cares about. Even if you know all that, are you an expert in that asset class, region, market? Honestly, it baffles me that people think they know what they're doing there.
Yeah, it just comes down to greed, really, and a lack of patience. What you should do is play the probability game.
Yep.
You should be investing into well-diversified funds where you've got exposure to local shares, but also international shares. Sometimes I hear as well, let's just invest into the S&P 500. Well, yes, the S&P 500 has done very well, but based off a lot of our research, the forecast going forward does not look as promising. Different countries will perform better at different times, which is why it's important to be well diversified. You got to be really conscious of fees as well and making sure you've got good diversification, not just across countries, but different industries as well.
Yep, 100%. So again, if you're thinking about doing the share thing, we're not saying that's a bad idea for everyone, but just play it smart. Do the smart thing. Play the probability game. You are not going to outperform the market over the long term. And I'm not saying there aren't people out there who have had some stunning wins off shares. They are few and far between. And it's like gambling. You'll hear about my wins way more than you hear about my losses.
For sure. And if you've got a mortgage, stay away from shares. We've talked about 1,000 times. I'll do it one more time. So you make 10% on shares, your mortgage rate's 5.5%. You take off fees, you're at 9%. You take off tax, you're at 6%. You take off inflation because you're not spending the money, you're actually at 3%. Your mortgage rate's at 5.5%. Way better to focus on paying off your debt and then start contributing to shares. But on the flip side, Michael, the other thing I do hear is going, I don't understand shares. They're not tangible. What would you say to those people?
All you're doing is buying into a company, right? And again, we're simplifying it down quite a bit, but really that's all it is. And, usually a company is rowing in the right direction to try and grow, And again, I don't understand shares. Look, there's a lot of opaque kind of jargon in the finance world, and it's been around for a long time. And usually it's there so that people can charge you a fee. And stockbrokers, boy, did they know how to charge a fee. And like sharesies and stuff, don't get me wrong, they've made it more accessible, but they'll still charge you a fee.
Yeah, everyone's just got a new idea and you have to make a trade. And by the way, I get paid on that trade.
Yeah.
Let's move across to property, Michael. So there's probably three main types of property I think about. New builds or just buying like a house, like a renovation style strategy, either single property or multi-unit, and then commercial property.
Cool.
Let's start with the first one. Why would somebody buy a new build investment property?
A new build investment property is probably the lowest touch form of investing into the property market, aside from your owner occupied house. It's new, it'll be in a good location, probably not going to break, probably be under warranty, should be pretty easy to rent out as long as there's demand in the market.
Yeah, and is it the strategy that will make you the tippy top amount of returns? No. But the big thing is you have taken action if you are time poor, if you're not sure what to do.
Yep.
There's some people who are time poor. Sometimes they're just adamant about, I want to renovate or I want to do this really complicated thing. And you're like, well, you work 60 hours a week and you want to see your kids. So how does this make any sense?
Yeah. And if I take that to the extreme, it is, I want to be a property developer, right? And I've got this block of land and I'm going to chuck 15 townhouses on it. I cannot tell you how much risk there is in that. And like, there's a reason that property developers are rich, because a lot of them are broke. There is so much risk in that project that, they deserve to be rich. If you can deliver 15 houses in a budget on time to a reasonable standard.
For sure. So let's move over to the renovation style approach.
Yeah.
Mike, this is where we're living at the moment with the multi-unit approach. What are the pros and cons to buying either a multi-unit or a multi-unit with renovations?
Yeah, cool. So there's two different types of the renovation piece. The doing the renovation and holding and doing the renovation and selling, right? What we typically refer to as flipping. The big risk with doing the renovations is that the budget blows out. And you can dress that up however you want, right? Like, I had to hold it for too long, I couldn't sell it. We found some mold somewhere and we had to replace all of this. Or actually, you know what? I thought I was going to do this. I changed my mind. Now I'm doing this. Or the cost of doing the renovation has increased while I'm doing it or while I'm buying the property. Cool. So that is the major risk. And you buy for this much, you spend this much, and you think you're going to sell it for this much, but the spend bit increases, and all of a sudden there's either no profit or you're losing money, right? At worst. And we do see people lose money on these. The buy and hold strategy, probably a little bit less risky because you're not so time bound on it, but there is still risk there. With the buy and hold strategy though, the one thing I would say is it's not passive, right? Like if you're buying, renovating and holding, there's a lot of time that goes into it. You've got to have some skills, some expertise, otherwise you will make mistakes. If you're working 9 hours a day, 8 hours a day, pretty hard to manage a construction project at the same time.
Yeah. I mean, there's just execution risk. When people give these numbers on paper, they always sound amazing. And I'm like, well, if you're asking me about the numbers, definitely do it.
Oh, yeah.
The question is, what is your ability to execute? Because all of these projects, I mean, we're doing one at the moment and we got told like, we need to rewiring, and it was going to be like an extra $20,000 or something, right? The grid. And we've got people that know what they're doing, but things just pop up that you don't expect.
And that's the thing. You just got to have a little bit of balance sheet for things to go wrong, if you're going to do some type of renovation project. It very rarely should it be your first foray into property investment.
Nice. Commercial property, Mike. So cool. What are the pros and cons of commercial property?
Pros, definitely the tenant type, right? You're going to get a higher yield. It's a bit more hands-off. There's some advantage around the lending and the tax and that sort of thing as well. But basically it is a bit more hands-off and you get a better yield. The cons, the barrier to entry. Generally speaking, you need at least a 40% deposit, and much more than with residential property. The more you spend on a commercial property, the much better it will be as an investment, right? The difference between a $900,000 investment property and a $1.1 million investment property, probably not huge, right? You flip that over into commercial, that $1.1 million commercial property is going to be a lot better than the 900 grand one.
Yeah, and I think commercial property is a no-brainer once you get to a certain size balance sheet and got a certain level of wealth compared to residential property, but it's very hard just to immediately just jump to it, right? Like you need some steps in between.
Yeah, and we see people trying to get there a little bit too quickly, selling assets in a down market, trying to swing for the fences straight away. It's a bit more of a long-term play. It should be your third investment property maybe at a minimum.
Yeah, because that vacancy risk and like having that mortgage will just crush some people.
Yeah, absolutely right. And you pay a little bit more and you get a little bit less on the lending. So having a vacant commercial property with a significant holding cost is going to hurt.
Cool. Next one, Mike, crypto.
Yeah. To be honest, James, absolutely nothing to say here. Next asset class, NFTs.
Yeah, look, I'm sure there's some people that have got some regrets. But don't we all, Michael?
Absolutely, James.
Okay, so that is our episode on all of the different assets and the pros and cons. The great thing is there are so many tools available to grow your wealth. You need to apply this to your own position and go not just to what are the assets that you like or you're drawn to, but based off your goals, based off your current stage, what is the right thing to do? Because Mike, a big thing is even if we're attracted to a certain asset right now, we don't have to go there right now. We've got to potentially build up to get there.
Yeah, 100%. And swinging for the fences too early can lead to some real disasters.
Much love to Lighthouse Financial for sponsoring this episode. Please subscribe to our YouTube channel. Follow us on Spotify. Give us a review. Give us a like. And we'll catch you next time.
Cheers.